On All About Stocks this week, good week on Dalal Street. The Nifty ends above 6150, gaining 1%. We'll tell you what your investment strategy should be. A slew of excise duty cuts announced during the interim budget. What does this mean for your stocks? We'll find out on the show. And our guest, G. Chokalingam, gives you 2 stock recommendations to bet on for the long term. Welcome to All About Stocks. Thank you for tuning in. This is a show that helps you find those special ideas within the stock markets that will make you rich over the long term. Over the next half hour, we'll design an investment strategy for you. We'll tell you what stocks you should be buying and which stocks will make you rich. We'll also answer some of the questions you sent in during the week. Remember, our email ID is at the bottom of your screen. Now, before we go any further, let me bring in my colleague Ajay right now, who has an update on how the markets did this week. Ajay, take us through it.
Well, it turned out to be a pretty okay week for the Indian equities. We've gained about 1% on the benchmark indices thanks to Friday's surge. In fact, good to see Nifty above the 6150 mark. It was a week where we did see some buy on dips kind of mentality at work as far as traders are concerned. The emerging market currency pack also stabilized, which Indian equities also benefited from. Net, it was a good participation from the banking stocks, from IT stocks, which helped the market to gain, mainly the blue chips. Pharma and cement was also one space which was providing quite a lot of support for Indian equities. Broader markets were actually trading sideways compared to the large cap peers. Going forward, it will be interesting to see how markets pan out. The kind of gains they've made already this particular week. Autos is also an active space, though the news flow was that most of the auto players have cut prices of their key products, mainly in order to give a pass through to the excise duty cuts which was announced in vote on account, but it did not really materialize a whole lot as far as outperformance from the stocks were concerned. Good news for consumers though. Going forward, traders say that all eyes would be on global cues, because that is pretty much the big factor driving Indian markets right now, that the third quarter earnings have ended. Macro commentary also will be important. The fiscal deficit number for the month of January will be out, and IMF has commented this particular week that macro situation in our country looks relatively okay. The only risk lies in inflation, and Indian economy should also be prepared for additional rate hikes if inflation remains sticky. Net, we were on a good wicket from here on. Let's see how the next week pans out. Expiry and macro data would really drive the direction for the markets going forward.
All right, Ajay, thank you so much for joining us and giving us all of that information. Our guest this week is G. Chokalingam, founder of Economics Research and Advisory Private Limited. Choka, thank you so much for joining us. Ajay took us through what happened this week, and I want to start off by the interim budget, which is what happened at the beginning of the week. We saw excise duty cuts in an attempt to boost manufacturing. Let's first talk about consumer non-durables. Do you believe this excise duty cut will turn around these stocks? Even for the short term, what sort of impact will they have?
Certainly, it will turn around for the current quarter because people will prepone the purchases. Since the benefits are available till June 30th, so obviously there will be spurt in the recovery. And post-January, you will have the new government. Hopefully, there will be some stability. So that way, it has come at the right time, and it can, make even long-term impact. As I said, if stability is there, the spurt in the sales can continue even after June. So that way, it's a good move.
All right, so between now and June, there are obviously some of us who have these stocks, consumer stocks in our portfolios. Should we be looking for opportunities to maybe get out or book some profits?
Certainly. I mean, in consumer, there are some stocks quoting at 30, 40 PE, and some stocks have given even, 40 times return in the last 10 years. So obviously, irrespective of the macro development for the sector, you be very specific on the individual stock and don't lose touch with the valuation multiple. Okay. So if you're making good money, you should definitely come out of.
Give us a couple of stocks that are on your radar right now that we can watch in our portfolio, and if it hits a certain level, we then sell and get out.
Something like TTK Prestige. I mean, about 15 years ago, the stock was quoting around 45 bucks, no taker, and today it's close to 4,000. So these are the kind of stocks, where the story has already unfolded. And the management is good, no doubt. But in market, game is different. So when the story unfolds, you have to be there at the right time to unlock it and, put the money in the bank deposits.
All right, so take out from TTK Prestige if we see it hit a high. The other question I want to ask you is about the auto industry. Now, we know the auto industry has had a bad year, which is why the finance minister brought down excise duty on almost all vehicles. What will this mean for our auto stocks? Is it again between now and June? And should we be looking to take advantage of this period?
It will have impact, but it will not have substantial impact. As I said earlier, it has to be complemented by a good, robust political economic outlook after June, because already there are reports of companies having inventories, so they have to slash the prices for the inventory which is already produced. And secondly, there will be a lot of preponement of purchases by the consumers to make use of this benefit. So which means in the next quarter, unless there is a revival in the economy, the sales are going to come down. So therefore, it's a pure short-term phenomenon, and definitely you can make use of this phenomenon in the sense.
How?
Look at the players who have done very well despite the problem in the industry.
Which are these players?
Like for instance, M&M. Despite having problem in SUV segment where everybody is jumping in and eating into the market share, they have done phenomenally well in the tractor segment, and overall they are doing pretty well. Similarly, Tata Motor, though they have pain on the domestic front, the JLR is helping. So these are some of the ideas one can look at, but I would be a little cautious on two-wheeler.
A lot of analysts are saying buy export stocks, so buy pharma, buy IT. Do you agree with that? Should we be loading up on pharma and IT right now?
Definitely one has to focus on export, no doubt about it. But pharma, I am a little cautious for two reasons. One, the valuations are highly stretched. And two, recently the US FDA chairman has come and he said doubling the officials in India. So now US FDA people will have more time to go and inspect even the smaller companies. So let us not rule out this warning and alerts for more number of players. Definitely, yes, for IT stocks. And the whole market is ignoring the textile segment. If you look at the textile segment, there has been a huge turnaround. There are many textile good quality management companies are available at a 2-3 PE. So this is the time for the retail investors to look at textile stocks.
All right. I know we're going to talk about textile stocks a little later on the show, but since you mentioned IT, and we've been talking about IT for so long now, tell us, given the environment that you're seeing at this point, which IT idea do you like the most in our market?
Two ideas, rather three ideas I like most. One is a Polaris. I don't believe all this, growth not happening. Look at the valuation. It's available at 6-7 PE and huge cash. And management itself is interested in consolidation. Two, Mastech. And again, it is available in single-digit PE on 1 year forward earning. So my preference is for these companies which have got single-digit PE on 1 year forward earning, because there is a expansion of PE in the marketplace. Since there are not many opportunities outside these export segments, if you clearly observe, there are these companies going through PE expansion, IT and pharma, that would continue. So therefore, prefer mid-cap IT stocks which are quoting at a single-digit PE. Third idea is Emphasis. It is a big underperformer, but I firmly believe that the kind of company owned by HP and with more than $100 billion business across the world and a lot of cash on books, no reason for the stock to quote at 9 PE. So these are the three IT stocks I would definitely recommend.
You have Emphasis in your portfolio, and you're holding on to it from what I understand. All right, a quick recap. We are focusing on export at this point. In IT, we talked about Polaris, Mastech and Emphasis. And of course, remember earlier we talked also about Tata Motors and M&M. We're focusing on textile exports as well. That's coming up a little later on the show. Let me take a few questions. Vishal Singh has written in. He has 50 shares of Mahindra & Mahindra, which he bought at 896 rupees. He wants to know if he should hold on to that stock. M&M ended the week at 930. We know that it has reduced prices of passenger vehicles as well as its commercial vehicles because of those excise duty cuts. And you said that you're really bullish on M&M. So should he hold
Certainly,
on?
at least 1,000 rupees. But in the long term, one can hold. As I said, the management has the capability to turn around the Korean business, and they can even turn around shrinking market share in the SUV segment.
All right, let's take another question. Mangesh has written in. He has 150 shares of GCPL, which he bought at 830 rupees. He wants to know what sort of an impact the excise duty reductions on non-edible oils will have on the company's profitability.
Somehow I'm a little concerned about this company because the valuations are stretched. It's quoting around 30 PE, whereas ITC is quoting around 24 PE. So I would stick to the valuation discipline. Hence, I would prefer a stock like ITC.
Let's take a portfolio. Sneha has written in, and she sent us her portfolio. She's a long-term investor. She has 20 shares of L&T right on top, which she bought at 1,078 rupees. She wants to know if she should hold on to this stock. Now, the company will, of course, benefit from the excise duty cut on capital goods. But in the long term, for someone like Sneha, what do you recommend she does with L&T?
See, in the long term, definitely you can sell. Right now, she can hold, need not book losses. But in the long term, unless the economy revives and gets back to above 6% growth rate, the company like L&T will not create phenomenal wealth. Because it's already quoting at a 7 PE on 1 year forward earning, and the return on equity on a consolidated level is not very impressive. So, but I would not suggest sell at this moment. So hold it for at least 1100 rupee target. Then we can relook at it.
Well, since we're giving these answers to most of the questions right now, what happens to L&T if we do get a strong government post-June? If we have a consensus in Delhi and we actually have a full majority, then will a company like L&T benefit?
Certainly. I mean, it can spurt. We have seen in 2009 post-election, the market itself hit the circuit breaker. So if one of these two national parties gets somewhere around the 250, 260 number, perhaps again the market will hit the circuit breaker and stock like L&T will hit a 20% jump.
All right. So that's something that we should watch out for. Those of us who are investing in the market, really, it's all about the elections now. Well, Sneha also has 55 shares of PTC India, which she bought at 56 rupees. It's at about the same price at this point. Now, let's talk about that power sector. Is there any hope there? Should she hold on? What can she hope for?
I'm negative on power sector. I mean, all of us know the problems. But PTC is a peculiar company within the space, least debt and a lot of cash and good investments. And it's also available at a single-digit PE. And I would suggest a hold on to PTC India.
All right. Next stock on her list, 5 shares of SBI, which she bought at 16.41. Now, SBI has broken so many hearts over the last couple of quarters. What do you recommend we do? Hold on to SBI?
I think it will break hearts another 6 months or so. I've been negative on the stock for last 2-3 years. I continue to be negative because it's scary. The gross NPA above 5% and net NPA 3.2 is really scary.
She also has 115 shares of Syntex, which she bought at 35 rupees. Does it make sense to hold on to Syntex?
I would sell it. I mean, if you look at the half-yearly results, the inventory receivables are almost equivalent to the sales. And on the other hand, the debt is more than 3,000 crore. Times are difficult, although we are all optimistic that one of the national parties will come. In case it doesn't happen, this kind of highly indebted company will have serious trouble. So I would sell it and buy very safe stock, something like a MOIL.
Well, stay with us. After the break, Choka will give us 2 ideas of stocks that we can buy for the long term. Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. G. Chokalingam is with us, helping us figure out our long-term strategy when it comes to buying stocks. Now, we've asked him to go through the entire market and come up with 2 stock ideas that he thinks make sense for us at this point, that we can buy right now at this value and hold for the long term. Now, the first of his 2 recommendations is RSWM, formerly known as the Rajasthan Spinning Weaving Mills. Now, that's a bit of a tongue twister, but let me tell you a little bit about this company. It's one of the largest textile manufacturers in the country, the current market cap of nearly about 300 crore rupees. Now, we've seen India's textile exports have significantly improved over the last few months. 22% growth we've seen in textile exports in December alone. So is that your rationale? You talked about this a little earlier as well. You said focus on exports, and something that people have not been looking at is textiles. So does it make sense then to be buying the stock because of the exports?
Certainly. I mean, you just look at mid-cap pharma stocks, the way they have performed, or mid-cap IT stocks. 2 years ago, not many would have visualized, but only a few people visualized and made a lot of wealth. So market always, the theme plays out in an unexpected manner for 90% of the investors. So I may be wrong, but I firmly believe that next would be the textile space, because earlier in the past, the textile industry used to have a lot of fluctuation in the performance. They lacked the consistency in the performance. But today, because China is getting out completely from the cotton textile, in India, the prospects for the cotton textile has improved a lot. So by interacting with a lot of experts in the cotton textile industry, I've learned that this is going to be a story for next 2 years. Also partly because of the crash in our rupee. Let us not forget the fact that rupee has crashed to 55% in the last 6-7 years. So therefore, some of these good quality textile companies will do very well.
So obviously, if I'm going to get in at this point, I have to be prepared to hold on for the next 2 or 3 years.
Not really, because what happens today, if some market discovers some idea, it flares up in a matter of 2-3 days also. But I'm not forecasting that. But I don't understand why the stock is suppressed. If you look at the RSMW, that is Rajasthan Spinning and Weaving, it's quoting at less than 3 PE. It has got 500 crore of branded sales, in denim and suitings. And last year they made about 24 rupee EPS and they paid 10 rupee dividend. Now first 9 months itself they have done 33 rupees EPS. So I'm forecasting around 43 EPS. And in case they increase the dividend, the yield itself will be around 8%, and also they are into exports. So when market discovers, this can flare up also.
All right, the stock is currently at 129.75. What's your target on this stock?
Conservatively 165, but in next 2 years, I won't be surprised if it doubles or triples.
All right, so it's a stock that might double or triple your money. That's the first recommendation that Choka has brought us. The second one is Heritage Foods. Now, a quick introduction for you if you're not familiar with Heritage Foods. It's one of the largest private sector dairy enterprises in the south of India. The company recently expanded into the food and grocery retailing business under the brand Heritage Fresh. Now, those of us who live in the south are familiar with Heritage Fresh. Current market cap of the company is about 470 crore rupees. Tell us why Heritage Foods makes your list.
It's a solid growth stock. In the last 5 years, if you compare with the 2009 and with the 2013 sales, the sales have nearly doubled. And least, leveraged. The debt is very small, insignificant. And third, it has got its own network of retail outlets where they sell value-added dairy products. And the share of that particular segment is also growing. And fourth, it has got a huge network of dairy processing centers. They've got more than 120-30 chilling centers. And finally, now I think it's a ripe time to look at some of the stocks in Andhra. Because of the Telangana issue, a lot of businesses had problems. So this company has got a lot of presence in Andhra. So the resolving of the issue also will be positive for these kind of companies. Finally, recently we have seen an acquisition of unlisted dairy player,
right,
at one-time sales. Whereas this is quoting only around 0.3 times sales. So therefore, I believe this is a stock one should hold on to.
If we're talking about the Andhra-Telangana problem that has now been sorted out, which means that now people can actually start planning out the businesses going forward, which are the other stocks you think are going to be impacted by this positively? What should we be looking at?
There are few more. I mean, something like Hyderabad Industry Limited, and in fact, in the same show we covered it about 2 years back. We gave successfully sell call also. The stock has corrected from 560 to around 265 level now. It belongs to CK Birla Group company. In the last 10 years, if you see, rarely it made losses. But because of this, in my view, partly due to the political issue, it made losses in September quarter, minor loss in December. Now, this is a company which is likely to get the maximum benefit out of this political issue, resolution of the political issue, because the products are lumpy in nature, and they were impacted while transporting these cement products within the state. So this is another stock which I believe can get a lot of positive benefit out of the political resolution.
All right, so I'm going to put those 3 stocks on your screen right now. These are suggestions by Chokalingam that these are ideas that you can pick up at this point. Remember, the last 2 stocks will benefit from the fact that the Telangana issue has finally been sorted out. Let's take a few more questions. Ganesh has written in 900 shares of Voltas, which he bought at 105 rupees. He wants to know if he should hold on to that stock. Weak net profit, mute demand. What should he do?
I think he should sell. I mean, it's a great company, great management. But if you look at the August price, the stock has already more than doubled. And this kind of capital good company is not going to even improve the performance by 40-50%. So I think tactically one should sell Voltas and buy safe stock like RSWM, which has not run up in the market.
All right, we just talked about RSWM. Let's take another question. Hamid has written in, he has 20 shares of Havells, which he bought at 645. He wants to know if he should hold on to that stock as well. Now, the stock ended the week at 770, which means he's not losing any money on this. Now, Havells made an acquisition in 2007 that was causing concern and was muting their balance sheet for quite some time. Margins are improving, but does it make sense to hold on still?
It's a good company. I mean, it's paying off all the acquisition and all. But problem is because of the slowdown in the economy, if you see the consolidated level, the top line is expected to grow in a single digit next 2-3 years. And the stock is quoting at around 18 PE. So I am not comfortable, when the top line growth is expected to be in single digit, giving 18 times valuation. So you can sell the stock and buy stock like a Heritage Food, which I believe can give, relatively much better return.
We'll take a quick break. When we come back, we'll review Chokalingam's own portfolio, discuss stocks like NMDC and GSK Consumer. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. G. Chokalingam is still with us. He's helping us make money in the long term. It's time to look at Chokalingam's own portfolio. Now, if you're a regular viewer on this show, you know that each of our guests designs a portfolio on this show and we track its progress. Now, this portfolio was designed on the 8th of August 2013. It's so far at an overall gain of 13.2%. The Nifty over the same period is up about 10%. So you've beaten the Nifty by 3% there. Thank you for strong recommendations. I'm going to give our viewers a recap of the stocks in your portfolio. There's ITC, NMDC, RIL, Bosch, Oracle, Clarion Chemicals, City Union Bank, Emphasis, Karur Vysya Bank, Tata Coffee, Bama Lorry, Moil, Tilak Nagar Industries, JK Tyres and Glaxo Consumers. Do you, I understand you want to make some changes in this portfolio this week?
Yeah, certainly. I want to sell NMDC purely from the portfolio perspective because as a stock, I am still bullish on NMDC because in the portfolio it's giving such a phenomenal return. On a relative basis, I would like to swap it for Hindustan Zinc. Okay. Because I believe Hindustan Zinc can rise much faster than NMDC going forward. You know, sitting on 26,000 crore of cash as of September 30th, which is 50% of the market cap. And it is certain to make anywhere from 7,000 to 8,000 crore of net profit every year, next 3-4 years. So in the next 4-5 years, for such a private sector, large cap company, the cash could be equivalent to the market cap. So I firmly believe that this stock should, rise much faster than NMDC.
All right, so NMDC has given us 35% on this portfolio so far. And of course, like you said, don't get emotional about your stocks, know when to get out. What is the next change you want to make?
Glasgow Consumer, it's not working out well because I have chosen this tactically, hoping that there will be once again, open offer or creeping acquisition, which is not happening. So I firmly believe that, the heritage food can move faster than Glasgow Consumer. The rationale I have already explained, so therefore I have swapped it for Glasgow Consumer.
All right, I'm going to give you a recap of the stocks now as they stand. So there's ITC, Hindustan Zinc, RIL, Bosch, Oracle, Clarion Chemicals, City Union Bank, Emphasis, Karur Vysya Bank, Tata Coffee, Bama Lorry, Moil, Tilak Nagar Industries, JK Tyres and now Heritage Foods. 10% of that portfolio is in cash. I'm a little concerned very quickly about the number of stocks in this portfolio. That will require a lot of management for a normal investor who has a job. So this is not what he's doing through the week. It's a lot of stocks to have in a portfolio, isn't it?
See, normally one should have around 12 to 15, because volatility has increased. If you look at the way the stocks are falling, even for some news, so it is better to, spread across around 12 stocks ideally. But if you are willing to take a lot of risk, I would put money only in 6 to 8. But then the risk will increase substantially.
Also, I want to ask you, we have you back in the studio every 4 or 5 weeks. But is that the ideal time that I should keep checking my portfolio? Would you rather have me check it every week or once a month? What's the ideal frequency that we should manage with?
I think you should have a trigger whenever some stocks flares up. We should not wait for 1 month. For instance, the Bosch, in between it ran up to 11,500.
Right.
So that you can do it to help your investors. So that will be a great compliment.
All right, so it is a long-term portfolio. For those of our viewers who are tuning in for the first time, I want to remind you that the idea behind this portfolio is you should be able to hold it for at least 3 to 4 years, really.
Minimum 2 years, I mean.
Minimum 2 years, but it does make sense to put an alert on your stock so that if one of them runs up or runs down very heavily, that you know immediately and you don't have to wait for a month to find out. All right, unfortunately, we've run out of time on this show. Thank you, Choka, for coming in. It's always a pleasure to have you. Send in your questions. If you have questions specifically for Choka, send it to us. Email ID is at the bottom of your screen. You can reach me as well on Twitter. Thanks so much for watching.